Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we are focusing on what you need to know to get ahead of the curve, and here's some of the trends we're going to be diving into. Wall Street seeing red today. U.S. stocks slid, pulling back from their recent rally, with all three major indices ending the day down. The message from the White House is defense, defense, defense. President Trump wants the U.S. to have an ambitious Golden Dome project, but what would it really take? And how much money will it cost to implement a missile defense system similar to Israel's famous Iron Dome? And the future of AI is top of mind in Silicon Valley. Yahoo Finance live at the annual Google I/O conference. We're going to have the latest concepts, gadgets, and technology coming out of that closely watched event. Well, navigating uncertainty still seems to be the theme on Wall Street. Our next guest, no stranger to the ups and downs of the market. Tim Anderson is managing director at TJM Investments, and he's based on the floor of the New York Stock Exchange, where he joins us now. Tim, it is good to see you. So maybe start big picture, Tim, and curious where you think this market is and where we're headed. I spoke to Adam Johnson recently on the show. Adam, portfolio manager, friend of mine, all around very smart guy. And Adam telling me he's broadly constructive on the market, Tim. And I asked him why, and he said, it's simple. It just comes down to the two E's. And by that, he meant earnings and employment. And as long as those are solid, Tim, his point was, he's going to stay constructive on this market. He thinks there's just generally more to like than fear. And I'm curious to get your take on that.
Look, Adam's had a great call on the market. He's been stalwartly resistant, even at the lows 6 weeks ago. And I think I certainly do not disagree with him. I do think that the path of least resistance is higher. And I think there is some selectivity required in both sectors and individual stocks. I have to be a little bit careful about how I talk about individual stocks, but definitely the market has had a much stronger, faster V-shaped recovery off those lows that we saw right at the heights of the tariff tantrum, if you want to call it that, about 6 weeks ago. And look, we're at an inflection point right now. We're up near where we were 6 weeks ago. It's the next move. 5% higher is not going to be easy, but it certainly feels like both the macro picture and the earnings picture for individual companies is headed in the right direction.
So we can look, Tim, we can say, listen, earnings solid, economy running, I think 2.4% according to the Atlanta Fed tracker. I mean, those are reasons to stay positive. What would be on, Tim, your list of worries? What would be on your radar of concerns?
Well, obviously, if we got through the next month or two and had very disappointing progress on the making tariff deals and trade deals with key trading partners around the globe, I think that the market would not receive that very well and maybe take another turn lower. And I think if you were to just have a complete stalemate in the major conflicts around the globe, particularly the Russia-Ukraine conflict, and a complete refusal from Iran to do any negotiations on their nuclear capabilities. Those would be two major sources of concern for the market.
Tim, we're talking stocks. I'm also interested to get your take on the role of commodities in investors' portfolios, and which commodities?
Well, look, we certainly agree with the train of thought out there that we're at a year or two into a commodities, a secular commodities super cycle. Gold has had a very nice move, 50% up over the last 12 to 18 months. One area that we've spent a lot of time looking at is copper. It has trailed that move significantly. I certainly think that with the incredible amount of industrial production that's been committed to take place in the manufacturing sector of the U.S. from not only domestic companies but foreign countries around the globe, close to $10 trillion. Copper, although it's been under the weight of the Japanese spending, the Chinese spending boom kind of hitting a brick wall a number of years ago, it it has to have significant upside from this level just to support all of the additional industrial building that's going to go on in this country, and the electricity demands and just other infrastructure related power demands that will be required in addition. And of course, if you want to talk about individual stocks, I mean, the main blue chip in that sector has got to be Freeport Copper. It's certainly been in a downtrend since it reached the mid 50s almost a year ago to the date. But I think that the stock has recovered very nicely from its lows 6 weeks ago, and it's kind of poised between the 50 and 200-day moving average. You get a close above that 200-day, right around 41 for more than just a couple of days, and this stock could go back toward the high 40s, maybe the $50 level.
Tim, great to see you. Great to have you on the show today. Thanks so much for joining us.
Well, thank you so much for having me, and enjoy the rest of the day.
You too, sir. The S&P 500 snapping its 6-day winning streak as tariff relief rally fades. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
You know, I got to begin with the 30-year, which hit 5% again. And this brings me to my first takeaway. Treasury auctions are the new CPI. And just stick with me for a second here. I'm going to show you the 30-year first. This is a chart of the intraday price action in the yield. And you can see just fell short of 5%. If I put on the 2-day, again, you can see it actually exceeded that yesterday. And meanwhile, the dollar is slipping. And let me just find that right here. You can see the dollar going in the opposite direction. But why would I say Treasury auctions are the new CPI? That's because everybody's going to be watching these things. The global demand for U.S. debt is going to be a key factor, and it's going to be moving not only the bond market but also the stock market. And this is the schedule. I broke this down earlier in the day, and this is just a rough monthly schedule. Now, next week, the last week of the month, we're going to be looking at the 2-year, the 5-year, the 7-year. Those are important right here, but the real show is again the second week of the month. So we're still a few weeks away from that. The 3, the 10, and the 30. Everybody's going to become a bond market expert. We're going to have a bunch of them on the shows. That's my prediction, but that's basically what's going on here. And it just kind of speaks as to the weird action we've been seeing. You know, stocks were down today. Gold had its best day in a few weeks, and in fact, it's having its best week. It's only Tuesday. Gold's having its best week in 6 weeks, and meanwhile, Bitcoin's up as well. I like to throw that in there, but that's kind of bucking the trend. So strange things happening.
Strange things happening. Stocks, meanwhile, still really near those record highs.
Yeah, and that brings me to my second point, is that record highs are in sight. And in fact, we saw a record in the large cap industrials. XLI hit a record high only yesterday. So let me just show you the sector action, and I'm going to show you how far we are off of the 52-week highs. Everything's in the red because this is down from the maximum high. So industrials off a little bit, but they hit that record high yesterday. But you can see how close utilities are, and staples, and even financials. And just really interesting to see a broad swath of sectors, albeit some of these are defensive ones, really so close to these record highs. And by the way, the S&P 500 and the NASDAQ 100 are within 4% of record highs when we're just seeing these flashing yellow signals in the bond market right now.
All right, so flashing yellow signals.
Yes.
Added up, what is an investor watching this to do?
Well, there's nothing average about this, but it gets back to Warren Buffett likes to talk about dollar cost averaging. And I had the opportunity to sit down with Tom Hayes over at the New York Stock Exchange, and we were talking about various investment strategies. But when it comes to dollar cost averaging, that's just kind of adding money, whether it's from your 401k or just from your piggy bank, your savings account, transferring that to your 401k, to your trading account every few weeks. That's a pretty good way to go. And here's what he had to say about it.
I think the number one thing, like anything in life, is to be consistent. So if you're just buying the overall indices, like a VTI, Vanguard, Total Market, or an S&P 500, buy it every single month, a fixed amount, okay? And the months that you really don't want to buy it, where your stomach is churning, you're afraid you're going to lose your job, whatever it happens to be, those are the months you should buy double. Because when you buy down, you get more shares, and over time that compounds materially. So dollar cost averaging, that's kind of your base, you know? Put the majority of your money to compound that way.
And there you have it, dollar cost averaging.
And do you dollar cost average?
Every 2 weeks, my friend.
All right, thank you.
All right.
Appreciate it, sir. Stick around. Much more asking for a trend still to come. President Trump announcing plans for the Golden Dome today in the Oval Office.
I'm also pleased to report that the one big beautiful bill will include $25 billion for the Golden Dome to help construction get underway. That's the initial sort of a down deposit. And we have probably, you're talking about, General, we're talking about $175 billion total cost of this when it's completed.
Joining us now for more, we're bringing in Patrick Murphy, former congressman and host of Yahoo Finance's Warrior Money podcast. Patrick, it's always good to see you. So President Trump talking here about the Golden Dome missile defense shield, Patrick. You heard the president talk about this as a veteran, as a congressman. I'm curious to get your thoughts on the project.
Sure. Thanks, Josh, for having me on. So my thoughts succinctly are, frankly, he talked about the $25 billion investment down payment. That's about 5% of the overall cost. The CBO has scored this, Josh, at $500 billion over the next 2 decades. But it is that $25 billion initial investment in the big, beautiful bill that passed the Ways and Means Committee, et cetera, and looks like it's moving forward to the full House. And Josh, why this is important is you have China and Russia with developing hypersonic missiles that can evade our traditional air defense. So when you have ground-based and space-based sensors tied into the software, I think a lot of people are looking at it with a hopeful eye.
So the idea here being this sort of, as I understand it, Patrick, you'd have this sort of comprehensive protection of the country, right? Comprehensive protection of the homeland. Do we have, in your opinion, do we have the kind of the technical know-how, Patrick, to do this?
I think we're getting there. You remember, Josh, 4 decades ago, Ronald Reagan tried this. It was called Star Wars, and that was back in basically 1983. We did not have the technology then, Josh, that we have today. And it's building on the current sensors that we already have and the satellites that we already have, but tied to software and building more. And right now, Josh, because China and Russia is such a threat, really, when you look, and this is not classified information I want to give you, really, we're only protected in California and Alaska. Our East Coast is bare. Our southern border is bare. So, what it is trying to give us really the technology to defend America with this Golden Dome initiative and really be more proactive when we talk about our troops even deployed overseas.
Patrick, Politico does talk about and quote some Democrats who it sounds like have expressed concern about the effectiveness of such a kind of defense shield. They talk about how the U.S. already has 44 missile interceptors spread across California, Alaska. They also quote Senator Mark Kelly from Arizona saying, "I would love to be able to build a system that actually worked 100% of the time. To build a system over the entire country would be incredibly hard, and we're not sure it's going to work." How would you respond to that kind of what sounds like skepticism?
Yeah, I'm a big fan of Senator. I traveled to the Middle East with him and his wife. I would say this. One, we can't fight the fights of the past. We learned that after, frankly, World War II. It was called Task Force Smith in Korea. We were not ready for the Korean War because we were basically, after we just drew down forces after World War II. We have to prepare, Josh, for the next fight and have the technical and tactical advantage over enemies. We know that we are vulnerable when it comes to our missile defense. We have the best military in the world, but we need to make sure we give them the technical and tactical advantage. And so, I look at this with a more hopeful eye and realize, though, that it's $25 billion, Josh, that's in this bill, but it's going to be a cost of $500 billion by the CBO, not the 147 that was mentioned earlier. It's really about 5% of the overall cost. So we better make sure we're getting our bang for our buck because the ROI is incredibly important when we talk about our safety against the safety of our enemies, Russia and China, who are developing these hypersonic, missiles to, unfortunately, hopefully not attack us, but we got to prepare to fight and win if need be.
Patrick, final question. I'm just curious how you think foreign leaders might be responding to this news. I mean, you're Putin. You're there in Moscow. You hear President Trump talking about this missile shield. What do you think his reaction response is?
Yeah, I think they're going to think that we're serious when it comes to our defense. I think we're I think one of the again, Josh, I'm a Democrat, right? But I call it like I see it, brother. And how I see it is President Trump has been very critical of European nations not meeting their 2% GDP promises of defense spending in our nations. It's been about 1.8, 1.9%. They're now stepping up to the plate. I think that's a good thing. And I think what they're seeing is America continues to make an investment, getting their bang for their taxpayer buck when it comes to our defense and doing what's necessary to keep our families and our borders and our country, our homeland, safe. And I think this is an initiative that goes along those lines. I really do.
Yeah, I've seen some analysis that this kind of announcement could actually press Putin and Russia to spend more on their defense, more resources at a time where that country can at least afford it. We shall see. Patrick, thank you so much, sir. And be sure to scan the QR code below to check out Patrick on the Yahoo Finance podcast, Warrior Money. Well, stick around. Much more Asking for a Trend. That's still to come. Well, the Google I/O Developer Conference is wrapping up day one, and joining us for some takeaways is Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, there's been a number of announcements here. Some would say a flurry of announcements from Google at its annual developer conference. But one thing stands out, and it's something that Microsoft has also hit on recently, and it's kind of this outward spread of AI agents. Now, these are basically semi-autonomous or fully autonomous. Think of them as kind of apps, chatbots that are able to perform tasks on your behalf. So at Google I/O, what they announced was agentic purchasing. So when you go to buy something, say a rug or a handbag or tickets to a game, you'll be able to use an AI agent through what Google calls its new AI mode in the main search, and then make those purchases. So say, I want 2 cheap tickets to a Mets game on a Sunday in, decent section out of the sun. You would be able to put something like that in, that very natural language kind of conversation, and then get a result back. And then it would take you through, work its way through the entire purchase flow without you having to do anything, whether that's, inputting tedious shipping information or purchasing information, things along those lines. Microsoft also hit on this at their developer event on Monday, talking about how they see an agentic web of kind of forming a new internet around these AI agents. And so this is really kind of the larger trend that we're seeing from big tech more broadly. And it's not just Microsoft, it's not just Google. NVIDIA has hit on this. They talk about helping developers build AI agents with their technology. So this is something that's going to continue to grow, and we're only just starting to see the beginning of it.
Dan, you're ahead of this conference, tech analyst Gene Munster on X. It was interesting. Munster framed it as almost kind of existential for the company. He posted, "It's the company's chance to prove it's not afraid of the innovator's dilemma, and that's willing to take bold, outside-the-box steps to stay relevant in generative AI without blowing up the business model that built it." How do you think about that, Dan? Did they accomplish that today?
It's hard to say, right? I think one of the big kind of takeaways is that Google's trying to evolve past just those blue links that you get on the results page, right? So they've been slowly doing that since last year, right? They introduced AI overviews, those kind of AI-generated responses you get to some of your results at the top of screens. Now they're introducing AI mode, which is going to exist on the regular Google page where you would see, images, news, videos. AI mode is going to be part of that. So this is part of their effort to kind of move just beyond that. And we talked about earlier today the AI glasses that they announced with Android XR. That is also a part of this kind of experience that they're trying to use to move past just what Google has been. The thing is, that's their moneymaker. So we have to see how they try to kind of monetize all these new innovations over time.
Dan, thank you for your time, sir. Appreciate it. Well, the healthcare sector deeply out of favor right now, and it has been for a while relative to other sectors in the S&P 500. Yahoo Finance's Julie Hyman joins us now with a closer look in our chart of the day. Julie.
Josh, this analysis coming to us via Todd Stone over at Strategas. He's a technical analyst, and he crunches the numbers on ETFs on a regular basis. So this seen through the prism of the ETF landscape, he's really found that healthcare is deeply out of favor right now. So let's look at the chart first, and then we'll talk about a few items related to it. So what he looked at was the S&P 500 sector relative performance. You're looking at the percentiles here, and it's the last 5 years of history going all the way back to 1972. So what you're looking at here is that effectively industrials performance over the past 5 years has been in the 78th percentile relative to the S&P 500. How common is it for it to trade like this? Well, it trades like this with the S&P 500 about 78% of the time. So relatively regular performance for industrials, tech, energy, communications, and financials. But then you get to materials and discretionary, which have been trading a little bit more differently, utilities, which have been outperforming, staples, and then you get all the way to healthcare down here at 2.7%. In other words, since 1972, only 2.7% of the time has healthcare done this poorly relative to the S&P 500 over that rolling 5-year period. What does this have to do with? Well, this is a 5-year period, but we know what's been going on in the past 6 months or so has been the decline, and even more recently, really, the past 3 months or so, the decline of United Healthcare, which is a very heavily weighted healthcare stock. So that has partially to do with it. One of the other things he mentions is that the S&P 500's percentage weight of healthcare now is below 10% of the overall S&P 500 for the first time since 2000. He said if you look at the equally weighted healthcare sector, it peaked in December of 2021. And he also points out it's the third largest sector in terms of assets under management in ETFs. So when this sector does poorly, a lot of people hold it relative to others, and so it is not necessarily good news. From a technical perspective, does it mean things are going to bounce back? Hard to say here, but it is fascinating to see that that group has done so poorly on a relative basis, at least the money held within these ETFs, Josh.
All right, thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.